Well, hello, this is Dean Tenney. Welcome to my studio here in fabulous Las Vegas. We are working our way through our last explication of the FINRA Series 7 Content Outline Function 3, 91 questions. So last thing we need to be able to do in this function before we can move into Function 4 is go over debt securities. Now, some of this I've talked about in previous explications. I've also talked about this in various lectures that are available on the channel. All right, so let's get started. The first thing we need to know about debt securities are money market securities, and those are high quality debt maturing in less than 12 months. Like as it says here, commercial paper is issued at a discount. All money market securities are issued at a discount that's testable with the exception of a CD. It has a max maturity of 270 days. That too is testable. And it's a large unsecured borrowing by corporations, and that too is testable. And typically purchased by money market fund managers. Brokered CDs, what brokered means is that it's a secondary market. Another way we could say that is it's negotiable. As I said, most money market securities are sold to money market fund managers. And so it would be important to know that, this money market manager can meet his redemption request. So brokered, or I think the better word is negotiable. What you need to know is that it can be sold to a third party. Most CDs are not that. That's a unique thing. And it's jumbo. That means it's over 100 grand. R is another money market security you're held accountable for. Eurodollar bonds. Let's get a different section here. You have to be able to contrast a eurodollar bond with a euro bond. So in a euro bond, let's put the first one, eurodollar. You're lending the European company like Nestle, for example, dollars. You expect to be paid back in dollars. And since you're lending dollars, you're getting paid back in dollars. The point is there's no currency risk in a euro dollar bond. No currency risk. Let me get my different color going. In a euro dollar bond. Again, because you're lending dollars, you expect to be paid back in dollars. When my thing doesn't work, I'll just go to my other annotation tool here. No currency risk in a euro dollar bond. Now, what you got to be able to do is contrast that with a euro bond. Missing word is dollar, where you do have currency risk, right? You're lending euros or Swiss francs or whatever it is. You expect to be get paid back that. All right, so let's see. Eurodollar bonds, brokered CDs, variable rate preferreds move with whatever that base rate is. It's usually preferred stock. I talked about that in a previous explication. So, I think what FINRA, why they put it here in their content outline is because even though a preferred stock is equity from the issuer standpoint, it's a fixed income investment vehicle and the portfolio risks are the same, right? I have the risk they can't pay me the dividend. I have the, interest rate risk. So I think that's why they put it here in the outline, but we've talked about that elsewhere. Calls are very testable. Call risk. The first thing you need to know about call risk is associated with a declining interest rate environment. And, there's two things that prevent the issuer from calling away its debt instruments, prevent them from replacing high cost debt with low cost debt. And that's called call protection. And that's the call provisions, right? Call protection has two components. it has time, and the second component to call protection is price. Maybe the issuer says, Dean, we won't call it away from you for 5 years. And if we do, we'll pay you a prepayment penalty. So structures risk, you have credit risk in a bond. And then remember, besides credit risk, you have interest rate risk in both directions, right? Interest rates go up, the bond goes down on the secondary market. And if interest rates go down, then you have this risk of call, right? The risk of a call. Structured products are done by our structured finance men and women. And the whole point about a structured product, whenever you hear the word structured, it has a heightened level of suitability. Equity linked note securities, for example. The one they test on is an ETN, and I think I talked about that. It's guaranteed you're going to get questions on ETN. And the exchange traded note is a debt instrument. And that means if you own a ETN, you're a creditor to the sponsor. And you have the risk they may not be able to make good on that, right? The holder is a creditor to the sponsor or distributor. You're going to at least get one. That's usually the test question you get. So if I buy a 5-year exchange traded note and Credit Suisse says, Dean, this is linked to the Standard & Poor's, at the end of 5 years, we will pay you whatever, that did. So let's say during that 5-year period, the exchange traded note, I can sell to someone else. But let's say when the note matures, the S&P has gone up 36, so now they owe me $136,000 in that example. Types of non-U.S. market securities. We have both a sovereign debt from like Argentina. You have the risk of default. So, if they don't pay you back, what you going to do, right? And it's not like you are going to be able to, go down there and repo something, even though there have been some hedge funds that have followed the sovereign debt defaulters around the world trying to repossess their Navy ships and that. But in a sovereign bond, you have risk, debt, default. And then, it's going to be hard to, enforce any kind of a contract on them. And then we also have non-U.S. market securities and corporate debt. I brought up Eurobonds or eurodollar bonds, right? If it's a non-U.S. market security, the big thing besides default, they're always interested on the test, is this idea of currency risk, that if you're lending euros or Swiss francs or, pesos or whatever the case may be, that you have to turn that back into dollars. Now, let me clean up my slide here. Okay, types of yields. Ooh, very testable. So let's talk about our first relationship. So when it says calculations, by the way, the only calculation here you're going to have to do is current yield. You'll have to do current yield, but the others, it's just knowing the relationship they have to each other, And so when the bond is issued for test purposes, we assume the bond's issued at par. And when the bond is issued at par, we would assume that all these rates, all these yields are going to be the same. The fancy word for yield to maturity is the bond's basis. And that would all be the same for test purposes. And if we buy a bond at a discount, the relationship. Now, again, I'm not going to re-lecture the debt instruments. All of us, myself and my YouTube channel lecture, whoever your provider is, a lot of us use what's called the seesaw or teeter-totter to illustrate this relationship. And, I'm not going to be doing a lecture here. I'm just taking an intellectual inventory with you in these explications. So if we buy a bond at a discount, the nominal yield is going to be higher than the current yield, which is going to be higher than the yield to maturity, which is going to be higher than the yield to call. Nominal yield. I got this backwards. Nominal yield is going to be greater than the highest yield we're going to have here is going to be the yield to call. So nominal yield is going to be lower than current yield, which is lower than the yield to maturity, which is lower than yield to call. Remember that's greater than. So the highest yield there is yield to call. And the test point here is that we are going to quote to the customer, people don't buy bonds based on current yield. Most people buy bonds, buy them and put them away. And what they're interested in is what they're going to make over the holding period, yield to maturity or yield to call, whatever the case may be. The way we say that is we should quote yield to worst. The lowest yield the customer could expect, not the highest. And so for a bond at par or discount, very testable, we're going to quote yield to maturity. Now, on the other hand, if we buy a bond at a premium, by the way, one more point here, we should know that if that bond is trading at a discount, let me go back up here. We should know that that's because interest rates have gone up, causing the bond to go down. That's really testable. That's called the inverse relationship. And here then we say we are going to quote yield to worst, and the yield to worst is going to be a yield to maturity here. Now the other situation, very testable, is that we buy a bond at a premium. And if we buy a bond at a premium, the nominal yield is going to be higher than the current yield, which is higher than the yield to maturity, which is higher than the yield to call. The yield to call is going to be the lowest of the yields in a bond at a premium, very testable. In a bond at a premium, the lowest yield is yield to call. And it's very likely the bond's going to be called because, their interest rates have gone down. Now, we talked about what would prevent them from doing that. It would be, the call protection, but you would quote yield to call. So in a bond at a premium, we quote yield to call. Very testable. And we should also know that if it's trading at a premium, that's because interest rates have gone down, causing the bond to go up. You do need to crunch current yield on a bond, and that's the annual interest, what it pays you. So I said you don't need to worry about these other yields. You just need to know about the relationship they have with each other. But you certainly need to know how to crunch current yield, and that's annual interest divided by current market price. Bonds, you definitely know lower than investment grade. So lower than investment grade. And the one that shows up on the test most often is Standard & Poor's. As we said, there's two risks when you buy bonds, credit risk and interest rate risk. And so less than investment grade under Standard & Poor's, we don't say junk because one man's junk is another man's treasure, but it would be less than triple B. Triple B is investment grade. Less than triple B is less than investment grade. Tax implications, don't get too much in the weeds on taxes, but if you buy a OID, original issue discount bond, like a zero coupon bond, you're going to do straight line amortization upward called accretion. Let me get a different color. And it's tax implications of taxable debt securities, OIDs. The interest is going to be taxable. The principal, the premiums and discounts, you can set up how you want in terms of capital gains and losses. It's called election. So, I wouldn't worry about that as a test issue. Types of corporate bonds, very testable. Mortgage bonds are secured by real property. Let me get a different color here. These are just definitional questions. By the way, the secured bonds, very testable, are seen here. Let me see, where should I put that? I'll put it up here. So we have two types of corporate bonds. We have, let me get my thing here. We've got secured bonds on the test, and we have unsecured. And what you need to make sure you know is that senior secured bonds are senior in liquidation to unsecured bonds. Okay, back to the various types. So mortgage bonds are secured by real property. Coming to you from Las Vegas, very popular with casinos. Equipment trust certificates are secured by major movable equipment. And to be major and movable, should be on wheels. This is very popular with airlines, rolling stock, for example. Then we have unsecured bonds. We have debentures. That's just the full faith and credit of the issuer. The issuer. By the way, in this category, we have two. We also have what's called a subordinated debenture. And that's where you're going to say you will claim, put your claim behind the regular debenture holders. And for doing so, we'll give you more money. So that would be some of our unsecured ones. A step coupon. I've never had anybody tell me they've seen a step coupon on the actual exam, but this is a bond in which what they agree to pay you goes from like 6% to 8%, over the life of the bond. I haven't had anybody ever tell me they've seen that. Zero coupon bonds are very testable. So zero coupon bonds, very testable. I can't imagine any draw in which you don't get a couple of zero questions. As you recall, I already gave you one about it. We said you have to do straight line amortization upward. And that's called accretion. You're going to owe taxes on the accreted amount. And that kind of sucks because that means you're going to be paying taxes on money you're not actually receiving. And that's not bueno. That's called phantom income. They're very good for somebody who needs a set sum of money at some future date. Like college, for example. Sometimes the way we say that is a target investment. A target meaning, you got a year where 18 years from today, somebody's starting college. We said, remember, they're not callable. So zero coupon bonds are not callable. So you don't have any call risk in a zero coupon bond. One thing you need to worry about in a zero coupon bond is they're going to be very volatile with interest rates. Now, it doesn't matter if you're, not going to be selling them. I mean, you'll be immune from that if you're just going to buy this and wait till the kid starts college. But, otherwise you could have some problem with that, right? You have no reinvestment risk because you remember you're not getting any money until the end. In a regular bond, every 6 months, you've got to decide what to do with the money. And depending on what happens, depends on what you're going to be doing, right? So zero coupon bonds have no reinvestment risk. Convertible bonds, very testable. So, when you buy a convertible bond, you can switch your status. You can switch your status from being a creditor to becoming an owner of the corporation. And so what we've got to be able to do on the test is we got to be able to calculate parity. Whoop. I don't know why I put it there. Get my different color again. You got to be able to both calculate parity of the bond and parity of the stock. And one really important note you need to make to yourself is when given the conversion ratio, you need to establish the conversion ratio, when given the conversion price, you need to establish the conversion ratio. And so I'll just make up one here. Let's say that par is 1,000. The way you do that is you take par and you divide by the conversion price. So if I say the conversion price is 40, You know, the minute you see conversion price of 40, you got to say, ah, man, they're trying to trick me. I get out my calculator here. $1,000 divided by 40. So I get 25 shares. So that's really important. So now I'm back in business. You know, the thing was originally issued at par, but now let's say on the test, I tell you that the current market price of the stock is 50. And the current market price of the stock is $50 per share. So what you've got to be able to do is say, well, okay, well, if I can get 25 shares of the common, parity means when they're equal. So if I can get 25 shares of the common and that's $50, then parity of the bond is $1,250. You're going to have to do that on the test. Now, let me put this in a different color here. The other thing I might do on your exam is give you the current market price of the convertible. Say the current CMP means current market price of the convertible is 1,300 or 130 in bond speak. What is parity? And then you'd have to divide by the 25 shares. And you would tell me that parity, let me get my calculator, 1,300 divide by 25 is 52. You're going to have to do both of those. High yield bonds are bonds that are less than investment grade. It just means you're taking more credit risk. Income bonds, kind of weird. I don't have anybody tell me they've seen anything about income bonds in a long time. But income bonds only pay interest when and if earned. They're used in bankruptcies and restructurings. So pay interest. Interest only pay interest when and if earned. They trade flat. That means no calculation of accrued interest. And they're typically used in bankruptcies and restructuring. So kind of a trick, you know, retail investor says, I need income. The one thing they don't want to buy is an income or adjustment bond because that's the one thing it doesn't do. These are used in bankruptcies and restructurings. And the point here is retail investors shouldn't probably be involved in bankruptcies and restructurings. Let's see, we did talk about convertible bonds already. We talked about the conversion privilege stated as a price, you need a yield, fixed versus variable. Conversion ratio, we talked about that. Calculation of parity, very, very important. Arbitrage, let's put that there. Arbitrage is profiting from price discrepancies. Let's put the definition there first. And so my example here, we had a convertible bond trading for 1,300. We figured the parity was 52, right? So if we saw the stock trading at something above 52, we'd say, oh my goodness, I can buy this bond at 1,300, convert it into the stock at the equivalent price of 52, and the stock is 54. I made 2 points. So, you know, you would want to certainly do that. The conversion ratio will be adjusted for any stock splits or stock dividends. And so, you know, if they pay a 2-for-1, it'll be, you know, twice as many shares at a lower price. If you always remember more shares at a lower price, you'll be in pretty good shape. Now, influencing conversion, you can convert anytime you want. Typically, we wait till the end. You can't go back and forth. But at maturity, we're going to say, what do you want? Do you want 25 shares of the common or do you want $1,000 back? Now, we know what you're going to say. You know, if the 25 shares in this example is worth more than par, you're going to say, give me that. If not, then you're going to say, you know, I'll take back my money, right? So, all right. So it looks like we did a pretty good job of getting that explicated. Okay. I told you we're going to finish up critical function 3, which is investments, 91 questions. And this is debt securities. I have a beautiful lecture on CMOs. It's a whole lecture on them. So again, this isn't a lecture. This is just a explication, an intellectual inventory of stuff you need to know. So what do you need to know about CMOs? Well, CMOs, we're going to carve up a mortgage pool into various cash flows. And we're going to end up with two tranches or slices. We're going to end up with PACs, and we're going to end up with TACs. Plan amortization classes versus targeted amortization classes. And when we carve them up, what you need to know on the test is that PACs have more predictability and therefore lower risk than targeted amortization classes, because the PACs are typically the earlier cash flows. Boy, it looks like I'm having some spelling problems here. It sounds like my family is messing up in the kitchen. I don't have the door to the studio closed. I apologize. You're getting background noise. PACs have more predictability and less risk than TACs. TACs have less predictably, more risk, more of a speculative bet, so to speak. CDOs are just other things we carve up besides Ginnie Maes and Fannie Maes. We can carve up car loans and credit card receivables, and again, it would be no different than that. We're going to have an indenture, very testable. The indenture is the promises between the issuer and the trustee for the benefit of the bondholders. Contract or covenants. And the trustee for the benefit of, FBO means for the benefit of the bondholders. Maturities, forms of ownership. I would know forms of ownership. Well, I guess first let's do maturities. We have a term maturity. Term maturity, meaning all the bonds come due at once. And we have serial maturity. That means bonds come due at the next at different times. Serial is typical of GOs and equipment trust certificates. I wouldn't worry too much about that. Forms of ownership. Most bonds today, test question, most bonds today are fully registered. In the old days, there would physically be coupons, and you'd have to clip the coupon to take it to the bank to get paid. So most bonds today are fully registered. And what that means is there's still a bond certificate, but the issuer will send you the appropriate checks at the appropriate times. So if you get this as a test question, most bonds today are fully registered. Registered as to principal only means, again, it has coupons, but if you drop one of the coupons, somebody finds it, they can cash it. I wouldn't worry about that at all. Bearer, no bonds today are any more bearer form. The bearer bonds, physical possession, presumes ownership. Nobody does that anymore. And the one that I would be aware of besides fully registered. So the two I'd be ready for in your exam is fully registered, most bonds today, and book entry. Book entry means there is no physical evidence of your ownership, or in this case, ownership and no physical evidence of the ownership of test question, the Treasury. Treasury Securities are book entry. The U.S. Treasury has you on the books. They send you the appropriate checks at the appropriate time. So you'd be confused if you own a Treasury security and say, Dean, transfer and ship. There is nothing to transfer and ship. That's also popular with state GOs. A lot of state GOs are book entry. So I wouldn't worry about registered as principal only or bearer, but I would worry about fully registered, and I would worry about book entry. A, B, C, D as an answer set, most bonds today, and you'd say A. If I say U.S. Treasury securities can best be described as, and then you'd say D, book entry. Interest payments, calls. Some bonds have put provisions. So we talked about call provisions. Call provisions are advantageous to the issuer in a declining interest rate environment. And we talked about that. And we said that US government securities and zeros are not. But put features are advantageous to the bondholder. They allow the bondholder under certain circumstances, to put the bond back to the issuer. And so you say, gee, Dean, these bonds pay a lower interest, lower coupon than other bonds I've been looking at. I said, well, no doubt. I mean, do your other bonds, can you put them to the issuer if you'd like after a certain time frame? This would be a very important feature of today's environment because interest rates are very, very low. And so a put provision allows, what happened to my annotation tool here? Allows the bondholder to put the bond back to the issuer. And this is advantageous to the bondholder in a rising interest rate environment. So call provisions are advantageous to the issuer in a declining interest rate environment. Put provisions are advantageous to the bondholder in a rising interest rate environment. So after 5 years, I'll just make it up. You can put it back to the issuer. And you would do that if interest rates went up. Calculating accrued interest. We have what's called the Uniform Practice Code, which standardizes practices within the securities industry. You can imagine what a mess the securities industry would be if we were all doing it differently. So we all agree in secondary trading to the Uniform Practice Code, and it says that the buyer of a bond is going to pay the seller of the bond the dollar amount of the accrued interest. The idea here is if I sell you the bond today, you say, well, Dean, I said, listen, I'm selling it to you today. Well, today is June 12th, and you're going to get a check on the next time frame, and it's not going to be yours. Some of that money belongs to me. You say, well, Dean, when I get the money, I will give it to you. I say, no, let's just figure it out now. So the way we're going to do is we're going to calculate it from the dated date. The dated date is very important. Dated date is the date the bond starts to accrue interest for the next time frame. So the dated dates would be J and J or F and A, or it means January and July, February and August. February and August, F and A. February 1 is when it starts accruing interest, or F and A 15, whatever the case may be. And we calculate from the dated date up to, but not including the settlement date. I know in these explications, you probably get tired of me saying, oh, I have a lecture, go see the lecture. Yeah, well, here it is. I have a lecture, go see the lecture. I'm not going to start calculating the number of days of accrued interest because we have a lecture in which we do this for you. I have a nice shortcut I show you. Here we're just explicating and telling you what the intellectual inventory, the things you need to own. This isn't owning it through the explication. This is telling while you're studying whoever your vendor is, Kaplan, Past Perfect, Knopfman, STC. This is to help you when you're doing your reading, you're watching their videos, you're watching my YouTube lectures, that you say, oh yeah, I remember Dean's talked that I need to know how to do this, right? So anyways, we don't want our high talent men and women to have to memorize nursery rhymes and knuckle humps about how many days have September. And so for corporates and munis, very testable, we're going to use a 30-day month and a 360-day calendar. And settlement is going to be T plus 2. T plus 2. I can see we're getting ready to talk about govies, and govies are goofy. They settle T plus 1. And they use an actual counter. Maturity, we talked about the two types of maturity. We talked about the type of collateral, either real property or, the airplanes. We talked about priority of claim. You're definitely going to have to rank the priority of the claims from senior securities to junior securities, secured bonds, unsecured bonds. Yes, you should be able to go into the equity, preferred, and common. So we talked about call provisions. So last thing we need to talk about before we finish explicating critical function 3 is we're talking about in big picture debt securities. In earlier explication, we did munis. So now we're on our last of our explications, which is debt. And we talked about corporate debt in today's explication. Last thing is U.S. Treasury securities. T-bills are sometimes referred to as the risk-free rate of return. Because you have no credit risk in a Treasury bill and you have no interest rate risk. You know, whatever's going to be happening, you know, you're just going to roll into whatever that is. These Treasury bills are issued at a discount and they trade in the secondary market at a discount. You know, notes and bonds. Notes, I guess let's carve this up a little further here. Are 2 to 10 years. I would know that governments are goofy. As I mentioned, corporates and munis, the minimum spread I'm ever going to make if I work the bond desk and I'm trading munis or corporates, I'm the one who's buying corporate or muni bonds into our inventory and selling them out of our inventory. The minimum spread I'm ever going to have is 1/8. But when trading treasuries, my minimum spread is going to be a 32nd. That's true of both notes and bonds, right? They trade in 30 seconds in the secondary market. Bonds would be more than 10. Now, remember in these ones, you don't have credit risk in these securities, but in treasury notes and treasury bonds, you still have interest rate risk. Again, that wouldn't matter if you're going to hold them to maturity, but you know, if interest rates go up, these things are going to go down, right? So you still have credit risk. Treasury receipts. There's 2 versions. The one that comes from the U.S. government, and one that broker-dealers have stripped. These are the same as corporates in terms of what the test questions are. What I mean by that is you get the same test questions, right? They trade flat. They're good for targeted investment. Somebody needs to set some money at some future date. The main benefit is you don't have any credit risk here. You know, you're still going to have to pay income tax, taxes on that accreted amount. And then tips. I would expect a question about tips. Tips have a direct relationship with interest rates. And so what the government's going to do semi-annually is they're going to adjust what they owe me by whatever the CPI is. I shouldn't say interest rates, with inflation. It's the only one that has that direct relationship. And that's based on the consumer price index. That's testable. The consumer price index is used to measure inflation. That is very much a test question. So for example, if the CPI goes up 8%, the government says, Dean, we now owe you, let me just get my thing here. The first, now they owe me 1,040, and then they owe me another 4%. It'll be 8 semi-annually, so times another 4%. I'm not going to make you do this on the test. You just got to kind of get a general idea of this compounding thing, right? So whatever that number is, that's what the government now owes me next time. We talked about types. We talked about maturities. We talked about payment of interest. GNMAs, very testable. have the full faith and credit of the United States government. That is very much a test question. Nothing better than that. They pay a test question. They pay interest and principal monthly. I would definitely know that. And again, if you are interested in more government questions, go to my lecture on CMOs called GNMAs and CMOs. It's a whole lecture on this stuff. Obviously, I'm coming down the back nine here, and I'm not going to be doing a full lecture on this. But this is testable. So, I mean, I'm not saying it's not testable. It is. They're fully taxable. U.S. Treasury Securities, the feds, the U.S. can and will tax me on interest I receive on Treasury notes and Treasury bonds. The states would like to, but can't. So this is a little different. This is fully taxable. Both the U.S. government and the states are going to tax me. So I would know all three of these things for test purposes. GNMA has the full faith and credit of the United States government. It pays interest and principal monthly. It's fully taxable. Now, these other ones have the implied backing of the United States government. We assume that if these Fannie Mae and Freddie Mac, that's the colloquial term for those, got into trouble and asked for assistance, that it would be, a given. But implied is not the same as direct. I haven't had anybody tell me they've seen anything on Sallie Mae in years. So, but if you see something, say something, right? So, part of, what helps me help others pay it forward is debrief. Now, I'm not allowed to ask people like, what was question 35? But what I can say is, what do you think we could have spent more time on? Or you're allowed to say, Dean, you told me not to worry about it. And, I got a question on it. So that's kind of how that works. All right. Well, it looks like I brought this in at a little under 40 minutes. Again, this isn't a substitute for the, 40, 50 hours of lecture we have on Series 7. These explications are just intellectual inventory. So I hope you have found them helpful. People tell me they are, because as I started them, I was more than happy to stop on critical function 1 and hit the delete key, but people find them to be helpful. I think the way I would use them if I were a candidate would, as a preview, perhaps watch the explication of the content and then go study, or use them as a review after I've done the section, just run through the explication again as an intellectual inventory. So maybe preview or review. I don't want you to think these are standalone study items, that they in and of themselves. I mean, they'll get you some points, but I mean, I don't want to have a worry in my back of my mind that people think they can, the day before their test, watch the explication and pass it. It would be ridiculous. Anyways, we're always good at responding to any questions you have. If you put it in the comment box, I'm pretty good at getting back to you pretty quickly. This will premiere on the premiere. This will be next Thursday. So that doesn't matter if you're watching this historically, but if you're watching this historically and the premiere has come and gone, you should always subscribe to the channel. And here's why. There's always new lectures coming. I have ideas, but people send me ideas. We always got new content coming. And when we have that new content, I put it on the channel and it says premiere. Now, at the premiere, you don't have to join us, but if you do, this is Thursday. By the way, if you participate, why Thursday? The guy who was on the previous version said he's testing Friday. He said, hey, Dean, can you put this thing up for me before my test date? Since he's a consumer of our channel. And I said, yeah, we can do that. So that's the other reason you can participate. So there's live Q&A we run with the chat for questions on the lecture, any questions you have. And if you participate like this fella did, we can, ask you what when you're testing. I'm not agreeing to alter the YouTube channel's publishing dates because of your test date. But if you are, on that explication, the Q&A, we had 2 very loyal people, and if I can make something happen for them, I'm going to try to do so. That's why you want to subscribe to the channel, so you're in on that. Kind of like inside information on the channel, right? You'll know what's coming. I can say, hey, it'll be Thursday. You can tell me what you'd like me to talk about. So make sure to try to make the premieres if you can. Next, we'll start on, just so you know where we're heading. This is the end of function 3. Woohoo! And we'll be starting on function 4 next. That'll be the last function on the 7. 65, 66, I begin explicating that. So my assumption is if you're finishing up your 7 by watching these explications, what's next in your future is 63, 65, or 66. And I have begun those explications. Who knows, by the time you get there, maybe they'll all be done. Talk to you later. Bye-bye.